I'm Jerry McMillan. I'm your presenter today, and we're talking about better IRAs with safer returns. Rolling your existing IRA into a better IRA and investing in things that give you a better return. All right. IRA rollovers are happening every day. 5 million regular people every year invest on average or roll over on average about $70,000 each. About 4 million rollovers and about 1 million Roth conversions. And only about 2% of them are free from the masters of the universe, and we'll talk about what that is in a little bit. Now, rollovers happen when an employee rolls their savings plan, 401k, or thrift saving plans, or 503b, or other employer-sponsored savings plan into an IRA after losing the job, changing the job, or leaving the employer for whatever reason. Typically, you'll have the choice of leaving it where it is or rolling it over into another individual retirement arrangement vehicle. According to the study cited here, the rollover phenomenon will continue to happen, and it has for years. And 321 billion last year in 2013, over 7% increase over 2012. The interesting fact in this particular study is that less than 8% of all financial advisors are of a category of retirement specialists. So as you're talking to financial advisors, make sure that you're talking to an advisor who understand the issues of retirement. Now we're going to take a look at the government's Thrift Savings Plan, which is the defined contribution plan offered to government employees. And the TSP is managed by BlackRock Capital Advisors. Kind of wish I had that contract. And really, it's a group of indexed funds. I read something that says many employees don't understand what funds they're in, and so but the thing about these particular set of funds is they really are a good representation of the risk spectrum across the market. They begin with the G fund, which is the only fund that guarantees the return of the investor's capital. It invests in government securities, average security maturity about 11 years, but you can't lose money in the G fund. F fund invests in fixed investments, bonds, and similar things, and it actually mirrors the Barclays Capital U.S. Aggregate Bond Fund. Their C fund is a index that reflects basically the Standard & Poor's 500, a broader view of large companies, large and mid-cap companies in the U.S. The S fund, small cap, larger Wilshire index, about 5,000 or 4,500 funds companies that aren't in the S&P. The I fund mirrors Morgan Stanley's international index fund. And so the funds that are available really represent a variety of risk complexions for employees to invest in. And then they actually have life cycle funds that are managed funds versus the index funds that have a targeted maturity for when one would begin to draw down. So they have a 2020 and a 2030 and a 2040 and a 2050 life cycle managed funds, which of course the one with the longer time horizon will be a little more aggressive than the one that expect the money to be needed to draw down in the next 5 years. So that's a good representation of the respective flavors for risk and the appetite thereof. Now, looking at the results from these funds over the last varying periods, you can see that as expected, let's take a look, start with the G fund. As you can see, over 1 year, less than 2%, 3 years, less than 2%, 5 years, 2.3, 10 years, 3.39%. Since its inception in 1987, whopping 5% return, still a couple of points above inflation, so you're not losing ground. The F fund in the last year is actually a negative return on the fixed income investment, 3-year, 5-year, 10-year, and over the life of it since 88, whopping 6.6. Again, modest returns. C fund, investing in the broader market, not a bad year in the last year. That's 3 years, 5 years, 10-year return. So you can see that in the short term there have been some fluctuations between that 5 and 10-year period to bring that 10-year average down to 7.4%. But since its inception in 88, about a little over 10%. The S fund, broader market, not bad year last year. 3 years, not bad. 5 years, not bad. 10 years, about as expected. Since inception in 01, 9.3. International fund actually underperforms, in my opinion. 1 year, 3 year, 5 year, 10 years since its inception in 01. Actually well underperforms the S fund, which is the broader U.S. market. Generally, when you take the risk of an international fund, you expect higher returns. But a very good reflection of the spectrum of risk available. Generally, you're talking about these funds reflect other managed funds in the marketplace, and that's about what you're looking at given the respective investment classes. So, moving on from here, let's look at some specific years in these funds. Let's look at 2011, and even the managed funds, although there are long-term managed funds, took some dips. But the G fund, again, you don't show a negative number in the G fund. But the fixed instrument fund in 2011 had a pretty decent year. The C fund, corporate, didn't make a lot of money. S fund lost money. International fund lost even more. Then if we take a look at 2013, G fund, again, you never lose money. You don't make a lot, but you don't lose any. Even the fixed instrument fund lost money in 2013. C fund had a good year. S fund had a good year. I fund had a good year. Year to date, not real impressive. C fund doing reasonably. And so you can see from year to year the fluctuations, variations, despite you're managing the risk through your choice of investment. The only investment where you're not going to lose money is the one where you're not going to do very well against inflation, more risk. You all know the story. Longer time horizon, since the mid-20s, similar numbers, small stocks on average, Dow Jones large stocks by both analyses, real estate, bonds, T-bills, the so-called risk-free rate, and compared to inflation, where you get your real return by subtracting inflation from your nominal rate as stated here. By class of investment, recent spreads just as expected, and depending on when you're looking at that, you got the broad U.S. market, you got the emerging markets, real estate investment trust. Let's take a look at the 10-year. 10-year from 2002 to 2012. 10-year U.S. market, emerging market, Vanguard fund and index look pretty good. REITs over that 10 years, real estate investment trust, look pretty good despite the ups and downs and ebbs and flows of the real estate market. the real estate investment trust looked pretty good in ending for the 10 years ending 2012. Broad bond market, lower risk markets, longer term treasury bond market respectively. So you can see what returns have looked like even coming through our recession period. You can see our investments have held up reasonably, recovered some of the losses of prior periods. Looking forward, real returns in this case as opposed to nominal returns. So net of inflation numbers similar to what we have seen in the prior slides. What are the big boys doing? The big pension 401k administrators, and this information comes from a Putnam study. In 2008 alone, about 5 years worth of assets gains were wiped out of U.S. pensions. So they've been scrambling to make up some lost ground. They are focusing on alternative investments. One quote, Harvard University's endowment, the worth billions, 40% allocated to alternatives in 2013. They're focusing on diversification to lower risk, strategies that focus on inflation fighting tools like commodities and real estate. Inflation fighting real estate. Greater risk awareness leads to more alternatives, which that's code speak for overly exposed to the equities market, which means we've got far too much money in the stock market, and so the big pension houses are investing in alternative investments, including real estate, and looking for advice on how to do so. Safety, based on a Charles Schwab study, is the paramount concern for us in our retirement dollars and our assets. We want protection first and growth with protection. That's really evidenced by 49%, or roughly half of us, are managing risk through cash investments. Means that if half of us have half of our money in cash investments, that means a fourth of our money is in cash, subject to the ravages of inflation. So we want to offer some safe investment vehicles for your IRA to take advantage of growth without those horrendous ebbs and flows that we looked at earlier. The governing guidance comes from IRS publication 590, which gives us our guidance on individual retirement arrangements. And you can see that real estate is a common IRA investment. Now, direct investment in real estate is not for everyone. Some people choose to avail themselves of the opportunities through indirect real estate investment trusts, and investments in the kinds of organizations and companies that we are. The kinds of opportunities that we represent are opportunities for your IRA to invest in real estate without necessarily having to directly manage the real estate investment processes day to day, which we'll talk some more about. You can do that through the ability of your IRA, and you have to think of your IRA as a person. Your IRA is totally separate from you. Your IRA is an entity that is investing and seeking returns. It is a trust, and you have a fiduciary responsibility to that entity to manage it according to the rules to its best advantage. And you can do that through investing in real estate, as we talked about. You can invest in companies. You can invest in loans. You can be that IRA can be the mortgage lender. Your IRA can invest in companies. Your IRA can invest in a number of instruments as long as it follows the rules. Now, there are some things that it explicitly cannot do. Your IRA cannot deal with you as the owner. You cannot do self-dealing. You as an IRA owner cannot earn a commission. You cannot earn a fee. You cannot earn a side deal based on your IRA's investment by the virtue of the fact that you are directing this trust to act. You can't have a side deal to make money, nor can your parents or grandparents, nor can your lineal children or grandchildren, your sons-in-law, your daughters-in-law. Anyone else with a fiduciary responsibility cannot have a side deal where they're making money based on what they got this IRA entity to do. And this IRA entity cannot invest in any company, partnership, trust, or LLC that you own more than 50% of. Now, those disallowed persons or disqualified persons, your IRA cannot sell them things, your IRA cannot exchange things, your IRA cannot lease them things, your IRA cannot lend them money, your IRA cannot lend them, provide goods and services that benefit them. Your IRA cannot allow them to crash at a house that your IRA owns. Your IRA cannot transfer anything to any of those disqualified persons. If your IRA owns a beach house and your daughter and son-in-law cannot stay there. It is disallowed. Two types of investments prohibited. Life insurance contracts as an investment. The IRA cannot choose to invest in a life insurance vehicle that has an investment component. It's not allowed. Collectibles, what are they? Any work of art, rugs, antiques, metals, gems, stamps, not allowed. Sports memorabilia, no matter how much Mickey Mantle and Michael Jordan and Kobe Bryant memorabilia will be worth, not allowed. No alcoholic beverages, no wine collections, scotch collections, no coins. Bullion, settled on an exchange, you can do. Now, you can maximize your nest egg. Your IRA can be maximized by you directing your IRA to leverage the benefits of real estate investments. Your IRA can own and manage real estate directly, or you can invest indirectly. And of course, I want you to invest with us indirectly. Your IRA can own shares of LLCs, partnerships, joint ventures. Your IRA can lend money. Your IRA can be the mortgage lender on transactions. A plethora of opportunities that your IRA, as a separate entity from you, can engage in at your direction. Now, our value proposition today, there are two options. You can take the safest option, one end of the spectrum. The contract will pay you 10% flat return on your investment, and your investment allows us to develop and build residential real estate. Or you can be a little more aggressive, and you can be a financial investor in the housing projects and share in the returns from those projects. Either way, your IRA can invest at your direction for higher, safer returns without the ebbs and flows of the market, the New York and the London markets that we saw earlier. I'm Jerry McMillan. I'm the project manager. I direct this process. And you see here on the screen from our last development project, a specific house with a foundation freshly poured. And on the right, you see the completed house. Now, and putting that same house in the Arlington area of Jacksonville, Florida, costs us $100,000 to build it, and it sells for $140,000. That's where we can pay you your returns. That's where we make our returns. That's what makes the whole thing go round. Next steps, pretty easy. You open a new self-directed IRA, at one of the custodians, and we'll show you a list of them. You roll over your funds into this new IRA, and then you direct that IRA to invest. The IRA disperses. All proceeds, returns, gains go back into the IRA, and at the conclusion of the project, you direct the IRA to invest in another one, and then you keep going and you do it again and again and again, and you get those growth that we are talking about. You see here is a list of custodians. We don't own or have an interest in any of them. I personally have been a customer of Equity Trust for over a decade. I am not endorsing any of them. They all work similarly. Same process. You have the new IRA, and your IRA invests in the kinds of projects that we have here, and whichever option you want that you're choosing, your risk complexion and your time horizon you choose. Generally, we ask that you be in for 6 months, and you can choose to stay in for longer. Generally, that's the amount of time it takes to complete a project, soup to nuts. And at this point, I will open it up for questions, and we'll get into more specifics, and everyone can have the opportunity to take the next steps. All right.